Hey everyone, welcome to Anu's classroom. So before we move on to the quick revision video, I thought we will discuss some more important questions and answers because I found a few more questions which related to topics which I feel are important to revise. Okay, so a few more questions we will revise in this video. So the first question we will be discussing is what is variance and how are the following variances calculated? And we are given four different variances and they are asking us to discuss the possible causes for each of these variances. Okay. So now if you have studied the next subject, that is MMPC 5 quantitative analysis for managerial applications, you would have come across this term variance over there also. So what is variance in accounting? That is our question in MMPC 4. So let us look at what variance is with regards to management accounting. So variance in management accounting generally gets used with the budgeting. Okay. So in budgeting or in management accounting in general, what is variance? It is the difference between the budgeted, okay, the budgeted or you can say the planned cost, okay, the budgeted cost versus the actual cost, okay, or you can say the budgeted value versus the actual value that was formed, okay, that was incurred. So this variance, we right now told about cost, but it is not just cost. We can calculate variance for both cost as well as revenue. So what is the budgeted or what is the planned revenue versus what is the actual revenue we got? That is also a variance. That is the deviation. You can say the deviation from what was expected or what is planned. That is variance. So in a formula wise, you can express variance as variance is equal to forecasted value minus the actual value. Okay, so you can express variance in using such a formula as well. So the next is how are different variances calculated and what are the possible causes for each of these variances. Okay, so what are the different types of variances? First and foremost, if it is based on cost or budgets, we have discussed earlier also, there are mainly three components. One is labor, the other is material, and one more was there, that is expenses. So here also if you check, right, the four different variances they have asked to discuss is direct labor and direct material, okay. So direct labor rate variance and efficiency variance, same way direct material price variance and usage variance. These are the four different variances which are being asked to us in this particular question. So first let us look at the direct labor rate variance and efficiency variance. So the labor rate variance, we can also think of it as the labor cost variance. So what will it be? It will be the difference between the standard cost or the standard rate for the production versus the actual rate that we incur during the production. Then what it will similarly, what would be the efficiency or time variance? It will be the difference between the standard amount of time that is being used versus or with respect to the actual the labor time that had to be used to produce certain amount of unit of goods. Okay, so that is rate variance and efficiency variance. So rate is the cost, efficiency is the time involved. So it is kind of like almost you can like if you look at this word itself, you will be able to understand the meaning of what this variance is with us knowing what actually variance is. Okay, so what are the possible causes for each of these variants? I'll come to it once we discuss what direct material price and usage variance is. Okay. So what will direct material usage variance be? It will be the difference between the actual cost of the actual number of units that were produced and its budgeted cost in terms of material. Similarly, price will be the, so usage will be the actual number of units produced versus the budgeted number, and price variance will be the actual cost that was required for materials versus the budgeted cost for materials. The next part of this question is to discuss the possible causes for each of these variances. A few of the reasons why direct labor rate variance could be there is because of staffing variances or benefit changes, incorrect standards, that is labor standard may not reflect the current or recent changes in the rates that are paid to the employee. So we might be looking at some past data and we might be budgeting our variance, but it might not be what is actually prevalent in the market while we are doing the operation. So those are some of the reasons why there could be a direct labor rate variance. Then labor efficiency variance, again it could be technological differences, then mismatch or misunderstanding between workers as to what exactly has to be done. So maybe the employees did not receive exactly what has to be done or what the end result is. Then each of them will be thinking of different uh, what you can say, different ways to achieve a target, or they might not be in sync with exactly what the organizational goal is. Then also this direct labor rate or time variance could happen. Technology again is an important part. Some unforeseen circumstances, like for example there was an electricity shortage issue in the middle of production, which was unprecedented for or unpredicted before when we were budgeting. It could cause delays in our project deliveries, right? So such things are you can write it as possible causes for direct labor rate and efficiency variance. Then again, material price variance, it could also be because we were not exactly aware of what the correct rate is there prevalent in the market. That could cause a material price variance. Maybe some economic fluctuations that happened after we budgeted, before we were executing it, which made our budget outdated. That could also lead to material price variance. Similarly, direct material usage variance, again unskilled workers, they might waste materials, so it will lead to more usage. Here also you can talk about the technology, effects of technology advancements, or outdated machinery, how it could affect, right? Unskilled labors could affect the material usage, or the quality of the material we supplied, that could affect the material usage. So all these things could end up causing a variance. Similarly, like you can look up and write down what all are the different variant reasons why each of these variances could come up. Okay, so I hope this variance part is clear to you, at least in context of this question. There have been repeated questions related to variance in multiple ways. So in case you have not touched upon that particular chapter, there is a dedicated chapter for variance in our textbook, okay, MMPC 4. So do take a look at it. It is a good candidate for the upcoming term and examination as well. The next question is a short note question where we are given 5 different things to write short notes on any 4. Okay, so we have 5 options. Out of that, they are asking only any 4. We will discuss all 5. Okay, money measurement concept we have already discussed in a detailed video regarding accounting concepts, the 12 accounting concepts. Please go take a look at that video. The 12 accounting concepts are important. I had said about it even in the previous video. I am expecting at least one question regarding at least one type of accounting concept in our upcoming term and examination as well. So do look at it and go. It is a very, though there are 12, it is actually quite simple. You just need to learn the headings and make a connection between what the heading is and what are actually the word meanings of it. You will easily be able to recollect and write it down. Okay, so please do take a look at it. Cost accounting. Next is cost accounting. So what is cost accounting? It is a form of managerial accounting which aims to capture the company's total cost of production by assessing the variable cost of each step of production as well as the fixed cost. Okay, so it is not actually a GAAP gap compliant type of accounting, and it is only used, cost accounting, it is only used for internal purposes. So when you are writing about a short note on this or even an essay question, you can talk first about what cost accounting is that we said right now. Then you can discuss about the different types of cost accounting. We have 4 main types of cost accounting, that is standard cost accounting. Then we have activity based cost accounting. So activity based cost accounting again is an important topic to be learned. Past previous question papers we have had essay questions based on this activity based costing. It was also last year's assessment assignment question, so there is a high chance that it could come up in our term and examination as well. So please do take a look at it. I had created a detailed video on this particular topic alone as well. The notes of it, if you don't want to go and read go through that entire video right now, the notes have been uploaded in our Telegram channel. You can download it from there and look at it, read it. Okay, so that is another type of cost accounting. Then we have marginal cost accounting. So marginal cost accounting also is an important topic. Just based on marginal costing itself, we have had previous years questions in the previous term and examinations. We had discussed a few of them in the earlier videos as well. So learn marginal costing as well. Then we have lean accounting. Okay, so these are the different types of cost accounting. You can write at least a small paragraph about each of these types of cost accounting. Then you can go ahead and give a example of a cost accounting. So as we said, cost accounting, it involves determining both the fixed and variable cost, right? So fixed cost is the expense that reoccur maybe at a fixed interval of time, maybe every month or every week or even every day, right? Regardless of whatever is the level of production. Like for example, our rent or interest on the loans we have taken, or any kind of debt or any lease expenses that we might have, all these things are examples of fixed cost. Yeah, with regard to the different types of cost accounting, actually, I forgot to mention CVP, that is cost profit, sorry, CVP, okay, not CPV, CVP, that is cost volume profit method. That is again an important concept only. We have had previous year question paper questions just based on CVP alone. So ABC, marginal costing, and CVP, please take a look at it and go, okay. Please don't skip these. There is a high chance we will get a question at least based on one of this as per previous year question paper patterns, okay. Yeah, so that is cost accounting. Next is accounts receivable. So accounts receivable, or AR in short, is a it is the balance money that is due to the firm for any goods or services that have been delivered or used, but it is not yet paid for by the customers. Like for example, if you are buying, let's say, a Dell laptop from the Dell store on credit, okay, once you do the purchase and you give them the credit card details, you will receive the laptop, right? That is, we have to now think from the Dell business side, okay. Why? Because we are MBA people, we are business administrators, we have to look from the business administration perspective now. So from Dell's point of view, Dell has already given you, that is the customer, the laptop, but Dell is yet to receive the payment from this particular customer. So you will be tagged as an accounts receivable for Dell. Okay, so that is accounts receivable. I hope you understood the concept. So what do you think this accounts receivable would be? We are owed, right? We are liable, or we are not liable. We are rightfully eligible, right? Eligible is the word. We are rightfully eligible to get the amount of money that is equivalent to the price of the product or good that we sold to the customer. So therefore accounts receivables are assets to the company. So when you're writing short notes, you can definitely tell about describe what accounts receivable is. You can give an example as like the one we quoted, or something else, whatever seems apt to you. Then you can also say that it is an asset and why it is an asset, or so such things you can write to make a short note out of accounts receivable. The fourth one is payback period. So payback period, it is defined as the number of years that is required to recover the original cash investment. Like you can say, in other words, it is the period of time at the end of which a machine, a facility, or some other investment has produced sufficient net revenue to recover its investment cost. Okay, like for example, if you I'm not sure whether you guys would have actually thought about it in that way, but definitely your parents would have. Like you might have heard your mom or dad say, like, okay, we'll buy this new car. It is worth say 5 lakh rupees. And if the person is, you might have said, okay, if this car I can drive for at least the next 10 years without much issue, then I would say that I have got the worth for my 5 lakh rupees. You might have heard some examples being said like that, right? So I hope you are able to make that connection. So what actually is having over there is, we are internally trying to calculate the amount of time we would need to recover the benefit of the investment that we have made. I would say, for example, recently something happened in my house. We applied for the rooftop solar system. Okay, so there was a particular bill amount. So the catch in this is that the electricity whatever is generated by our, so we did it from using a subsidy program through KSEB, that is Kerala State Electricity Board. Okay, so we installed the system, and while we were installing, actually they had told that the bill per month, okay, so rather than the 2 months billing, it will come to every month billing, and the fixed cost at that time we were expecting it to be like around 100 rupees or so, so around 100 to 150 rupees. So if when the bill used to come every 2 months, actually we used to get a little bit, what you can say, a good amount, often above 500 rupees or so we used to get the bill. Okay. So according to our calculation, what we thought is that, okay, we are spending this much amount of money, but then every 2 months we were expecting that at least 200 rupees or so minimum we would be able to save on our electricity bill. So internally, naturally, the calculation began. How many years I would have to wait until whatever money I put into this solar plant we could get back. So what actually, so when the calculations happened, naturally then and there itself we understood that it might not be a financially a, what you can say, a very bright move, uh, especially because the time that is required to get back on the investment is actually spreading across years. But then there is a freedom that right now, because of this net metering and all, we will be able to freely use electricity without having to worry much about the cost. So there are plus and minuses of all those things, but the crucial point is over here is that the calculation which we did was actually trying to understand what the payback period for this particular investment was. Okay, so that is payback period. I hope you understood it. The next is break even analysis. So this break even analysis, here it has been asked as a short note, but we have had instances where break even analysis itself is a essay type question, single essay type question. I think we will come to those questions in this video itself. So what is break even analysis? In financial calculation, break even analysis is something that weighs the cost of the new business, service or product against the unit sell price to determine the point at which you will break even. Break even as in you will neither incur any loss nor make any profit. Like for example, have you guys seen Avatar 2? It just released in December 16th. So there is an article in the web that is circulating as to at least how much like I think according to the statistics, this Avatar 2 should be at least the third or fourth highest grossing film in order to break even. That is, in order to break even, that is neither make a profit nor make a loss, and get back whatever was at least the producer had to bear in financially for making that film. And it is being termed as the worst case business scenario in all of film history so far. So that is break even analysis. More on break-even analysis we'll discuss further when we have that question. Okay, so we'll be moving forward for now. So the next question is again a four-part question where we are asked to distinguish between a few things: cash flow from operating activities and cash flow from investment activities. So this thing, operating activities and investment activities, we had discussed in detail when we were discussing about the cash flow statement, so I am not reiterating it. Please do look at it. Cash flow statements again is a frequently repeatedly asked question for term and examination. So if the pattern repeats, then we can at least see cash flow statements as well in the coming term and examination. Please read it and go as well. This also we have a separate video made in our channel. The PPT for the same is also available in our Telegram channel. You can go and download there. And one more thing I would like to request to you is that if you find these videos useful, do like, comment, share and subscribe to the channel, because it helps me in understanding that you guys really do like the content, and it will give me an incentive to make more and more of such videos for the upcoming semesters as well. Okay, so do consider subscribing and sharing our videos with your friends as well. So moving onwards, equity share and owner's equity. So if you would have remembered the accounting equation, we wrote the accounting equation as assets are equal to liabilities plus owner's equity. That is where we found out the word owner's equity. So while we were discussing about the accounting equation, we had discussed in detail regarding owner's equity. Okay, so I am not reiterating it over here, but let us look at what equity shares are. The equity share, it is also known as just share. Okay, when we say that we are trading in the share market, we have bought maybe so and so number of shares of SBI or Tata Steel or maybe GAIL or whatever that is, what we are talking about is the equity share. It is what you can say, it is a mm, the share is actually by buying a share, what we are doing is we are owning a part of the business, where each member it is a fractional owner and initiates the maximum entrepreneurial liability related to that particular trading concern. Okay, so this common stock is a form of corporate equity ownership. Okay, it is a type of security and it is a long term financing source for the company as well. These shares are usually issued to the general public, and there are different types of equity shares as well. So the different types of equity shares are, we have the ordinary shares, that is the shares of a company that is issued to raise funds to meet long term expenses, that is to raise capital. We have preference shares, bonus shares. So we had already discussed about bonus shares in detail in previous videos, where we were talking about a previous year question itself, right? We discussed both bonus shares as well as right shares. Then we have sweat equity, employee stock options, all those different types of equity shares are there. The next is net profit and funds from operations. This net profit is also, you can call it as the net income as well. So net profit is equal to the net income. And so what it is the company's total earnings after subtracting all the expenses. So the expenses subtracted will include the cost of normal business operation as well as any kind of depreciation on its assets and taxes incurred. Net profit is commonly referred to as the company's bottom line, and it is a true indicator of the company's profitability. Okay, the next is funds from operations. This funds from operations or FFO is also a measure of amount of cash flow that is generated by a company's business operations. It is also a what you can say, a component of our cash flow statement itself. And this funds from operation is commonly used to evaluate the operating performance of a real estate investment or something like that. Okay, a business that primarily operates in income producing real property is where this FFO or funds from operations is generally used. The next is operating profit and retained net profit. Again, profit means it is revenue minus expense, right? So operating profit, what it is the total income a company with generates from sales after paying off all the operating expenses, such as maybe it is rent, employee salary, equipment cost, inventory cost, all these things. Now, how is operating profit different from net profit is that this operating profit, it does not include gain or loss from any form of interest, tax or investment, whereas net profit did. So that is the difference between net profit and operating profit. If such a question comes also, I hope you will be able to answer so far. The next is retained net profit. This retained net profit, it is the amount of profit that a company has left over. Okay, the company has left over after paying all its direct cost, indirect cost, the income tax, as well as dividends to shareholders. So net profit is the net, or the net income is the what you can say, the revenue minus the expense, right? All sorts of expenses including tax and all. And this retained net profit is whatever is left to the company, okay, out of the net profit, even after paying the dividends to shareholders as well, all the direct cost, indirect cost, all the income taxes, as well as dividend to shareholders also, after paying off everything there is to be paid off, whatever is remaining with the company or the business, that is the retained net profit. By no means, let me tell you a disclaimer, by no means these sessions are encompassing all there is to say related to a topic. Okay, what the aim of these videos are to familiarize you with the type of questions that we have seen asked in the previous year's term and examinations, and give you an idea, a generic idea about what all things you can write down. Okay, or if you are hearing these terms for the first time, at least to give you a break into what these terms might mean. Please definitely go and check your textbooks or Google about these concepts to learn more. Because of time constraints, I cannot go in depth into each and every topic as much as I would love to. Okay, so let us move forward to the next question. The next question is, explain the difference between operating profit and net profit. Yes, we have already discussed it. Next is revenue receipt and capital receipt. Revenue receipts are the money that is received by the business through normal business operations. These are recurring and they affect the profit and loss of the business on the income statement. For example, we could say any kind of a rent received or interest earned, maybe money received from the goods and services that we are providing to our customers, any kind of a discount that we get from vendors or suppliers. Such things are revenue receipts. uh, Capital receipts, they are income that is generated from the non-operating activities of the business. um, so you can say capital receipt examples, you can say maybe you have sold a fixed asset. Okay, like you sold a piece of land that was belonging to the business to generate some amount of money, then that is a capital receipt, because the amount of money you got is from the sale of a fixed asset. Or any amount of money that you are receiving from your shareholders or debenture holders, any loans that you take or insurance claims that you make, the money which you get from all those things, they are all capital receipts. So revenue receipts, we said, we through rent or sale of goods or services, so they are actually recurring, right, in a business. Whereas capital receipts, they do not occur frequently. You don't, every month you don't sell off a piece of land, right? Once in a while you do, once in a while you might borrow. Correct. So that is the difference between a revenue receipt and capital receipt. Again, the next question is, what do you understand by direct labor cost variance? Distinguish between direct labor rate variance and direct labor efficiency variance. So this cost variance and rate variance, what I understand is they are both same. Okay, we have already discussed about this. So I'm not discussing it again in the same video. Let us move on to the next question. Okay, so the next question we are discussing is actually quite interesting question. They've given a quote and asked to comment on the statement. Not a quote, a sentence, and they've asked us to comment on the statement. That is, in managing cash, the finance manager faces the problem of compromising the conflicting goals of liquidity and profitability. Comment on the statement. And what strategy should the finance manager develop to solve this problem? Explain. Okay, so in order to answer such questions, let us look at the keywords that we can catch from these questions. So the first keyword I would say is liquidity, the next is profitability. Okay, next is problem. Okay, conflicting goals. Okay, so from this keywords, how can we form an answer that is worth 20 marks? Okay, so we can start by explaining what we understand by liquidity and profitability. What is liquidity? Liquidity management, it helps small businesses or businesses in general assess the financial performance, right? What is liquidity? The ability to, not the ability, how do we explain liquidity? Liquidity is the availability of liquid asset, right? Liquid asset is cash, so it is the ability of the company to actually easily generate cash. That is liquid assets, that is liquidity. The next is profitability. What is profitability? It is the ability of the business to earn a profit, right? And what is profit? It is what is left out of the revenue of the business after it pays all the expenses that are related towards to this revenue generation. Like for example, if the revenue comes from producing a product, then all the expenses that the business had to incur in actually producing and then finally selling the product to get this money comes under the expenses. Correct? So the difference between these two is what your profit is. So from this, what we can understand is that when liquidity is a measure of the availability of cash or cash equivalents, profitability is a measure of a profit of a company. Pardon me. Which the company can earn by selling the products or services. So both this liquidity as well as profitability, they are both related to the current assets or the working capital of this company, and both of them indicate how the business is performing financially, what the health of the business is financially. If the company is not having much liquidity, it means most of its assets are fixed and it may not be able to easily generate cash or working capital if the need arises, and that is not nice, right? It can be a cause of alarm for potential investors. Similarly, profitability, if the company is not able to generate profits as required, then naturally it is definitely having some problem in its management style, right, or the business model, then that is also a cause of concern. So while liquidity is kind of like the basic thing that ensures that the firm or the business is able to meet its short-term obligations, profitability is what keeps the company moving forward, right? It is the measure of the amount by which the company's revenues exceed its relevant expenses. So over the years, like there have been multiple opinions about which one of it is more important, and usually we have seen that there is a what you can say inverse trend between the relationship between liquidity and profitability. The reason being, uh, but if a company is having high liquidity, that means the company is having much amount of cash with them, right? There is a lot of cash available by the company at that particular point of time. But that might mean that the company is not able to utilize whatever assets they have, the cash they have, in the right manner, and that is why there is a lot of cash. Okay, so liquidity will not may not be pointing towards profitability. Profitability is also having good amount of cash in hand, but the cash has come because of the difference between the revenue and the expense, correct? So now when there is enough profits, how do we utilize that profit? Do we keep it in our drawers? Do we keep that cash in our drawers ready to be expended at the next given slot, or do we invest it wisely? If we invest it wisely in maybe fixed assets or some kind of short term assets, or um, in some investment, maybe buying some property or something, then the liquidity reduces because we are not having the cash that we have in hand, or the cash or the cash equivalents we have in hand is going down, right? So that is the conflicting goals of liquidity and profitability, right? Liquidity, the goal of liquidity is to have cash in hand, whereas profitability is to get the maximum return out of our investments or our assets. So that is how you can comment on the statement. Then what are the strategies that the finance manager could develop to solve this problem between liquidity and profitability? Some of the ways could be maybe identify and the liquidity risks very early, create a contingency plan, monitor and control this liquidity, make regular switch from this short term debt to long term debt, that is use this long term debt to finance the business instead of any short term debts, get rid of the useless assets, control overhead expenses, negotiate for some longer payment cycles. So these are some of the few methods with which you can solve the problem of liquidity versus profitability. The next question is, what do you understand by break-even analysis? Discuss the assumptions that underlie break-even analysis. How do they make break-even analysis unrealistic? Prepare a break-even chart assuming relevant figures. So break-even analysis, as we had discussed earlier also, it is a financial calculation which weighs the cost of a new business or a service or a product against the unit sell price to determine the point at which you will break even. Okay, the assumptions that are underlying in break-even analysis. So a few of the assumptions that are underlying the break-even analysis. One, the variable cost per unit is fixed. Okay, it is fixed production oriented but undergoes a transformation proportionally in relation to product. Second is that all elements of cost are divided into fixed or variable. Third, stock valuation is restricted to a certain cost. Four, there is always coordination between production and sale. Fifth is that this analysis is related to one product, and in the event of several product sales mixture, it is transformed into cost. Sixth is the cost and receipt are influenced by the volume of production. Okay, so these are a few assumptions that are underlying the break-even analysis. Then how do we make break-even analysis unrealistic? So these assumptions that underlie this break-even analysis, like the cost is going to be constant and all, they are actually unrealistic, right? Because sales prices may not be constant, right? And these break-even charts will give us big headaches, especially if finances are not what favorable to us. This representation of this cost and revenue by a very straight line is actually quite unrealistic. So because of all these assumptions that underlie this break-even analysis, it is actually quite unrealistic. To prepare a break-even chart, you can actually refer to your unit. Let me think. You can check your unit number 9. That is that unit is for cost volume profit analysis, but there is a mention about a break-even analysis and the different charts and all. So you can definitely take a look at both your unit 9 as well as unit 7 also has a few topics related to break-even analysis. I'm not sure whether these assumptions and all are mentioned. but definitely you can take a look. If you're not finding the assumptions there or exactly as per this question, do Google and keep, okay? That is the whole point actually. The thing is that while this, the way IGNOU actually sometimes formulate the question, not all of them are will be covered in our syllabus exactly. Some a few things might come like a general topic and all, which are not very much stressed in our paper. This is not to scare you, okay? First and foremost, let us study whatever is there in our textbook, and then only we'll go to whatever is not there, especially since this our new syllabus for MBA, it has come up only from, I believe, 2021, right? So maximum of 3 papers only I got, which is prior to which is this exact syllabus. Some of the questions are from the previous term and exams as well. So since the syllabus has changed a little bit, I think maybe some these assumptions and all might be from there. But since this is an important topic, this break-even analysis, I thought I will include this question as well, and we will just touch base upon it so that you get a generic idea of this. Okay, so I hope you guys did find our question answer sessions useful. If you did, consider subscribing to the channel so that you and hit the notification icon so that you will not miss any new videos. We have a lot of videos planned for the upcoming examinations as well as for the upcoming semesters as well. So consider subscribing if you like the content, and all the best. Study smart, and may you be able to ace your MMPC 4 exams as well. So all the best, and thank you very much.